Okay. So now I'm explaining you about the additional information for the for related to journals. So your question is what we do with bad debts. For example, today is 28th of May and we sold product. We sold product to, let's say, Mr. A, right? $1,000, right? So Mr. A give us promise to return this $1,000 back to us next week. So today we sold this product on credit. So sold to Mr. A means obviously on credit. So remember, if the question says sold product to Mr. A, but question doesn't say anything, is it cash or is it credit? So obviously it's credit. That's why we are giving the name of Mr. A. So when we record by the name of Mr. A. But if the customer is giving you cash, we do not need to know the name of customers because he's giving or she is giving us cash because that person will leave. We do not need to contact that person again because that person received product and service, we receive cash, that's fine. So you do not need to know the name. But if the customer is not paying you cash right now, then obviously you need to know the name. So when in the source document, it says that product sold to Mr. A or product sold by cash, it has a two different meaning. Sold to Mr. A means obviously product is sold on credit. So product sold to Mr. A on credit. So what will be the journal entry now? Quickly tell me journal entry for this situation. Tell me, sold product to Mr. A on credit, what is the journal entry? Quickly, what is the journal entry?
Or maybe cash account is debit and
Cash account debit
and the account receivable account credit.
Why cash account debit? Did you receive cash?
Oh, no.
No. So why cash? So what should be debit? What should be debit? Anybody else? Tell me what will be the journal entry for this situation? Someone said product debit and credit. What is credit? Product debit, why product debit? Can you explain to me why you consider product as a debit? Of course, this is wrong. Because first thing, it doesn't make any sense. Why you write credit, I don't know. Second thing, why you make it product debit, you have to explain to me. Anybody else? What will be the journal entry for this situation? Nobody knows? So two accounts will be affected. The first or second step, two accounts will be affected. Which two accounts affect here? Bad debts expense Why bad debts expense debit? Do you think this Mr. A is not giving you money? No. This source document doesn't say anything about bad debts. If I say, Mr. A, do not return money back to us on time, yes, then Mr. A is bad debts. But today you sold product to Mr. A, and Mr. A said that will give us money back, let's say next week, for example, maybe 5th of June. So Mr. A give us promise to return money on 5th of June. So 5th of June, we will understand Mr. A is bad debts or not. But right now, Mr. A is not bad debts because he will give us money next week, not now. Now just we sold product on credit. So how we record this transaction now? What we will record now? What is debit? What is credit? Sales, credit, account receivable, debit. Again, this should be opposite, right? Yes, that's right. Account receivable debit, but I'm not writing account receivable. I'm writing accounts receivable in bracket. I'm writing Mr. A because companies sell product to the many customers. So you cannot write everybody as account receivable. Otherwise, you're not going to track them. You're not going to understand who is giving you money or not. So account receivable in bracket, Mr. A. Account receivable accounts, debit. Why account receivable account debit? Because this is your assets. When you sell product to the customer, what I write down here, when you sell product to the customer on credit, customer become account receivable. So what you are doing exactly same thing. You're selling product to Mr. A on credit. So Mr. A become your account receivable, and account receivable increased. All right, you sell more credit, account receivable increase more. All right, means more people need to give you money if you sell more product on credit. So account receivable increased. All right, so that's why account receivable debit, and the credit should be sales or revenue. All right, sales accounts, credit, 1,000, 1,000. That's all. That's what you record on 25th of May. Understand? Now I come to your question. Your question was, teacher, what we do with bad debts? Now you have to understand first, do we have bad debts or not? So we will understand bad debts or not on 5th of June. So on 5th of June, we can see two different situations. I'm writing here, or two different situations. Situation one is your customer, yes, customer give you money, and no, customer do not give you money. All right, if customer do not, okay, so let's say customer give you money. Customer means Mr. A. Mr. A will pay you money on 5th of June. Can you tell me what will be the journal entry? If Mr. A, let's say this is called two situation one and situation two. Under situation one means Mr. A is giving you money on time and full money, which is 1,000. What is debit? What is credit? Tell me, what is debit? What is credit? Sales, credit, cash, debit. Cash debit, yes, makes sense. But why sales credit? Sales already credit. If you see here, sales already credit. Why you want to credit again? Credit means you sold. Are you selling again to Mr. A? No, you already sold it this date. You already sold to Mr. A on 28th of May. Now 5th of May, you receive, it's time to receive money from Mr. A. So why are you writing sales credit? Obviously, sales not gonna be credit. You're receiving money from your account receivable. You're not selling product to account receivable. Products already sold on 25th, 28th of May. Revenue already generated. Revenue recognition. That's the meaning of revenue recognized. You recognize revenue on 25th of May. I hope you remember these assumptions. Assumption or principles? Principles. Revenue recognition principle. According to this principle, whenever revenue recognized, you record it. All right. So we record, already recorded. Why you want to record it again? So obviously not sales credit here. So what should be credit here? Tell me. Anybody? What will be the journal entry for this yes situation? Nobody knows? No idea? Try to answer. So the answer is cash, debit, obviously, because you receive cash from Mr. A. So cash debit, which is 1,000, and accounts receivable credit 1,000. Why account receivable credit? Because account receivable reduce. He returned money back to you. So if you had, let's say you have a 3 account receivable. On 28th, you sold product to 3 different customers, Mr. A, Mr. B, and Mr. C. Now all these 3 people will pay you money later. All right. So means when you receive money from Mr. A, so account receivable reduce. When you receive money from Mr. B, account receivable reduce, account receivable reduce. That's the meaning of account receivable credit. All right. So cash debit, account receivable credit. And obviously account receivable is assets. When assets reduce, assets credit. All right. Now let's move on to the second situation that was your question, that what we have to do with these bad debts. You're supposed to receive money from Mr. A on 5th of June. So Mr. A do not give you money. So you did not receive cash. One thing confirmed. So cash will not be debit. So instead of cash, what will be debit? If cash not debit, what should be debit? What should be debit for your situation? No. So tell me, bad debts, debit, cash credit. Why cash credit? I just said you do not receive cash. Why cash credit? Okay, cash credit means cash out, cash reduce. Are you paying money to your bad debts? No, of course not. Are you giving money back to your customer? No. So why cash credit? Cash credit means cash reduce. Cash reduce means cash out. All right, so you're writing bad debts debit. Yes, that makes sense. Debit will be bad debts. So bad debts expense, accounts debit. Yes, because this is your expense. That's why debit, not cash. You don't receive cash. What should be credit?
Account receivable.
Yes, account receivable should be credit. Why account receivable credit? Again, you had three people, A, B, and C. So A do not give you. So how many left? Two left. So reduce. Total account receivable, reduce. That's why account receivable credit. They pay you, account receivable reduce. They don't pay you, still account receivable reduce. In both situation, on 5th of June, your account receivable gonna be reduced. Either option A, reduce because they pay you money, or reduce, they do not pay you money. So pay money, receive cash, do not pay money, bad debts. That's what you do with your bad debts. I hope it's clear now. Any question? Or move on? Any question or we move on?
Yes, move on, please.
Okay, so let's move on to the next. Let me send you this file. Okay, now let's move on to the fourth situation. Additional information. So next, additional information is your 3, which is discounts, So there are, obviously, we have two different types of discounts here. Two different types of discounts here. One is discounts received and discount paid. You pay discounts or you receive discounts. Two different situations we have here. Now, discounts received. When do you receive discounts? When you purchase. When you purchased something, purchase supplies, purchase material, whatever you want to purchase. Discount paid means when you sales, when you make sales, selling product and services generally, all right? Then you pay discounts. So now remember, if you receive discounts on purchased, this is your income or gain. This is your benefits. So for example, the price of product is $10, but after discounts, you are paying $9. $1 is your discounts. So this discount is your income. Discounts is your gain. Discounts is your benefit, right? Same thing here. If you sell something, then discounts will be your expense or loss. So remember this thing, right? So if you receive discounts, that's your income, that's my credit. If you pay discounts, that's your expense, so debit. Remember that, all right? So that's all for your discounts. Discount is finished. Any question regarding discount? Or move on to number 4. Now we move on to the last additional information. Then after that, I'll give you some questions to practice. So now the next is your purchase return or sales return. So we call it return. Returns. So we have purchase return or sales return. So we have 2 different types of returns here. We have purchase return and we have sales return. Now, what does it mean, purchase return? Purchase return means when you purchase supplies from suppliers and maybe the supplies has a problem, raw material has a problem, and then you return this raw material back to supplier. That's called purchase return. So means when you means company, when company or you return material back to supplier, that's called purchase return. And sales return means when account receivable or customer return products back to you. So obviously sales return is opposite of your purchase return. Sales return means you sell product to the customers, to account receivable. Maybe product has a problem and later on customer will come back to you and or account receivable come back to you and give product back to you. So that's called sales return, means you receive your product back, all right? So another name of purchase return is, we call it return outward. Sometime in your question, instead of writing purchase return, it says return outward. All right. And another name of sales return is return inwards. Return inwards. Outwards and inwards. Return outward means you purchase, now you're sending out. All right. And return inward means you sold it and now you get it back. So coming back to you, coming in. Right. These are the return informations you have. You must know when you make it your journal entry. All right, so now it's time to practice more questions. So let me have a look at the question, then I will send it to you. So here is your practice questions. So you have like 14 journal entries, and you have to do it all. So please do it all. Journal entries, 14 source documents. Some of journal entries, you know that you already done it before. Some are new, like bad debts and maybe account receivables, return or something. Tell me for the first journal entry, borrowed money from bank. Can you hear me? Yes or no?
Yes.
Okay. So give me the answer for first. Cash. Yes, cash account debit and bank loan credit 1,000. Number 2, issued share to shareholders 5,000. Second journal entry.
I think cash account is debit and share capital account is credit.
Yes, cash debit, share capital, credit. Number 3, sold product to the customer on credit 2,000.
Account receivable account is debit and sales account is credit.
Account receivable account debit and sales account credit.
Is credit.
Yes. Number 4, paid rent for office 1,200.
Rent expense account is debit and cash account is credit.
Okay. Number 5, return bank loan 1,000. Number 5, bank loan debit, cash credit. Yes. Number 6, purchase material from supplier on credit.
Material account is debit and account payable is credit.
Okay. Number 7, purchase building.
7 is building is debit and cash is credit.
Number 8, wages paid to the workers.
Wage expense is debit and cash is credit.
Number 9, cash received from account receivable.
Cash account is debit and account receivable is credit.
Number 10, tax paid to government.
I think tax account is debit and cash account is credit.
Number 11, cash paid to accounts payable.
Account payable is debit and cash account is credit.
Okay. Number 12, depreciation on computer.
Number 2, I don't know whether computer is credit.
So what is your journal entry?
I think depreciation is debit and computer is credit.
Yes, that's right. Depreciation expense is debit and computer is credit. Why computer credit? Because computer is an assets and depreciation reduce the value of assets. That's why computer will be credit.
So computer here is a value of assets.
Computer is assets. Normally, computer is like as machine or equipments that we use it to work.
but I think like with the same money, and we over the time we can increase the quantity of computers, so it should be increased.
Over the time we increase the quantity of computer. What you mean by you mean we buy more and more computers?
Like we increase the number of computer.
No problem. Like as you we are preparing T accounts for one asset, not the all assets. One machine, machine one, machine two, machine three, machine four. If we have 4 machines, we're gonna prepare 4 different journal entry. If we have 2 computers, we prepare 2 journal entries for 2 different computers. Or if
So
we are, yeah.
I mean each computer we have the journal entry, each journal entry.
If you are buying computer different dates, the
Yes.
buying dates of computers are different. One computer you buy this week, another one maybe next week, another one maybe next month and next year, then of course. But if you are buying all computer at the same time, so obviously all have a same life, all have a nearly same depreciation. So you don't have to prepare different T account or different journal entry.
Yes.
Right.
Thank you.
Number 13, computers sold at 1,300.
I think cash account is debit and sales account is credit.
Cash account debit and computer credit. Number 14.
But that expense is debit and account receivable is credit.
Yes, that's right. So that's all about journal entries. Now let me give you some more questions, but of course I'm not giving you long question. I'm giving you very short questions, a little bit the tricky one. I'm adding lots of information. So for example, company sold product to Mr. X, $1,000 on 20% credit and 80% cash with 10% discount. So one, do this one, and Okay, so you have a 3 different journal entry. Do it all. So they do not have any relations with each other. So you have to make 3 different journal entries. So give me the answer for the first question, which is company sold product to Mr. X, 1,000 on 20% credit and 80% cash with 10% discounts. Tell me. Nobody? Nobody done it? Yes or no? Tell me or I explain to you. Can you hear me for number 1 journal entry? Have you done it or you want me to explain you?
Can you explain it for us?
Okay.
I still not. Yeah.
So company sold product. So obviously sold product. So sales, it's a sales. 20% credit. So 20% credit means accounts receivable, which is Mr. X. Mr. X, account receivable, account debit, right? How much? 20%. So 20% is 200, right? And 80% cash with 10% discount. So means 80% cash. 80% cash means 800. 800 you receive cash, but with 10% discount, means after minus 10% discount. So means you receive only 720 because 10% is discounts, right? So, and discounts, how much is discount? This is 10% or $10, 10% discount. 10% discounts means $80. $80 is your discounts, and discount you are paying discounts. So that's why this is your loss or cost. That what I explained you before. So discounts on sales accounts debit, which is 80. Cash, you receive cash. Cash accounts debit, which is 720. And sales account credit, which is total is 1,000. This is the complete journal entry. If you want, you can make 3 journal entries, or you can make 1 journal entry like this. So now I'll show you how you can make 3 journal entries. First journal entry about here, 20% credit. So means account receivable to Mr. X, accounts debit, which is 200, and sales accounts credit, which is 200. Second journal entry is discounts. You are giving discounts. So discounts on sales debit, and sales credit, which is AD. And third journal entry, you selling 80% cash. All right. So cash account debit, which is 720, and sales account credit, which is 720. If you combine them all, it will be same. Look, debit 200, debit 200, debit 80, debit 80, debit 720, debit 720. So credit plus credit plus credit is 1000. Sales, sales, sales. So that's what sales credit. So you have two options. Either you can make it one journal entry, or you can make 3 different journal entries. So that's your one, which is finished. Is it okay? Is that okay? Any question? Any question, or we move on to number 2?
If we use 3 journal entries, how could we know where we will get the $800 to count at the $720?
Okay, you can calculate like as I calculated before. Okay, so look at here. Total was 1000, right? Total sales was 1000. In this 1000, 200 was credit sales, and 800 was a cash sales. In this 800, you have to pay 10% discounts. Right? So means you got 3 number. One is 200, which is credit sales, right? Then you got 720, that is cash sales, right? And you are giving discounts, which is $80. So that's why 80. So we got 3 different amounts. This is credit sales. This is cash sales after discounts, right? And here is your discounts, expense or discount loss or whatever you want to call it. Is that okay? Is that fine? Can we move on to next, number 2? Any question? No question. So let's move on to number 2. So number 2 is company receive the early payments. So it's an early LY. Company receive an early payments of 500 from account receivable at 10% discounts. So you receive money early from account receivable, but you give them discounts. You offer them discounts. So cash receipts. So obviously cash accounts debit, right? and you are paying discounts to your account receivable for early payments, right? Early payments, you give them discounts or make you payments early. So discounts to account receivable, and which is debit, and account receivable is credit. So cash we receive 450, discounts 50, and 500. Because we receive, total was right 10% discounts. So after discounts we receive 450, right? Which is 50%, 50 is discounts. Right. So after discounts, we got 450. That's your number 2. Is it okay? Number 2 is okay. Any questions for number 2?
No.
So
Yes,
let's move on to number 3. No questions. Number 3 is 80%, only 80% of 500 received from Mr. X on due date. All right, so Mr. X is of course account receivable. So we receive only 80% account receivable. So means 20% are bad debts, right? And 80% is cash. So journal entry is cash account, debit, bad debts account, debit, and accounts receivable accounts, credit. Cash, so we receive only 80%. So 400 we receive cash. So 20% are bad debts. So 200, 100, sorry. 100 are your bad debts and 500 are receivable. If you want, you can make 2 journal entries here. The first journal entry is cash, debit, account receivable, credit, and second is bad debts, debit, and account receivable, credit. There are 2 different journal entries. So here is 400, 400, and 100, 100. So it's up to you. Same thing here. If you want here, you can also make it 2 journal entries if you want it. It's your choice. All right, you want to make 1 or 2 journal entries. All right. Is it okay? So that's all for journal entry. So next class, we will start with our ledger. So next ledger is your step 3. So step 3, 4, and 5, we will study in our next class, right? So anybody has any question regarding journal entries or these questions or the previous exercise?
Can you explain again about number 3? I don't.
Number 3, okay. So it says that only 80% of $500 received from Mr. X on due date. So due date means the time to receive money from Mr. X. So It's time to receive money, but Mr. X is only giving us 80%. 80% means out of 500, we are receiving only 400. So obviously 100 we did not receive. So means 100 will be bad debts. In total 500, 100 is bad debts and 400s are cash. So that's why cash received and bad debts. Is it okay?